Hello guys and welcome back to another video. Now in today's video I'm going to be talking about British American Tobacco Company, giving my qualitative and quantitative analysis on the stock, and at the end of the video I'll provide you with my calculated intrinsic value for the company and whether I think that it is a value play or a value trap. So without further ado, let's get into the video. Okay, so as always guys, we'll kick it off with a little bit of qualitative analysis before we get into the numbers. So as the name would suggest, British American Tobacco, they produce tobacco products. They are the second largest tobacco company in the world based on market capitalization. And they are second to Philip Morris International. So they are huge. They have a market capitalization of around $88 billion. So very large company. Moving on to management. So we've got Jack Bowles, who's the CEO. He joined British American Tobacco in 2004 and became CEO in 2019. He holds approximately 215,000 shares for a value of approximately £6 million, which is good to see. We've got Tado Morocco, who is the finance director. He joined British American Tobacco in 1992 and became finance director in 2019. He holds approximately 64,000 shares for a value of approximately 1.7 million. So I haven't gone into all of the management for this company, and honestly there's not too much going on there, but here you can just see a screenshot of the shares which are owned by the directors. And as always guys, I like to look for companies that for management teams that are holding shares within the company that they are managing, as it goes to show that they have trust in the company, and they think that the price of the shares are at least a hold, if not a buy at that price. Just flicking back to the qualitative analysis then. So in terms of the key risks, increased government regulations. So Biden currently has a plan to impose rules to reduce nicotine in tobacco, which would make them less addictive and therefore likely lead to less revenue for the company. Not only that, he wants to ban menthol cigarettes. And one study suggests that banning menthol cigarettes in the US would lead to an additional 923,000 smokers to quit, which would obviously hurt British American Tobacco straight on the top line and on the bottom line. So just flicking on to another article by Reuters here, we see that Biden administration to announce a plan to ban menthol cigarettes. And the impact of this is pretty staggering. So according to a Bernstein research estimate, British American Tobacco PLC generates 55% of its cigarette volumes in the United States from menthols. So if menthols were to be banned, there's the potential that 55% of British American Tobacco's US sales volume could be reduced. So that is significant, and that's definitely something to bear in mind before making any sort of investment decision. So that is a major risk, and that is quite concerning. Going back to the qualitative analysis, another risk is that the industry is likely to attract tax hikes just because it's an unfavoured industry, and so it's an easy target for governments. In terms of opportunities, we've got the cannabis sector. So British American Tobacco purchased a stake in Organigram for 126 million, and that was a 20% stake. Now, in terms of what that could be worth going forward, if we flick onto this article here, we can see that it reads, the worldwide cannabis industry is projected to reach $90 billion by 2026. And that is a compounded annual growth rate of 28% in terms of value. So that's the worldwide revenue potential of the cannabis industry. Let's imagine that British American Tobacco were able to capture 10% of that total industry. That's an additional $9 billion of revenue, potentially by 2026. 5% of that would be $4.5 billion. And I think 5 to 10% might be something that they would probably aim for in terms of a sort of market share in that industry. So potentially somewhere between $4.5 and $9 billion in revenue by 2026 from the sort of cannabis sector alone. So that is quite promising. Moving now on to the quantitative analysis. So again, just running through the inputs into the discounted cash flow. 1 to 5 year revenue growth, I have put this down as 4%. Now, if we go to analyst estimates, they have this down as 6.43%. but I think that is a little bit optimistic. I think it's a little bit too high. I think if we go to the 2020 results, we can see that they're hoping for £5 billion in new category revenue by 2025. Now this is referring to sort of vaping products, sort of moving away from the traditional tobacco cigarettes. And if we go to the FY 2021 guidance, they're hoping for revenue growth in a region of 3 to 5%. So I think 6% is a little bit too optimistic for the next 5 years compounded. 3 to 5%, I've gone in the middle, 4%. I think that is fair for the next 5 years. Now on the 6 to 10 year revenue growth, I've actually gone for a negative 2% per year. This one can be a little bit more tricky to predict, particularly for the tobacco industry, just because it often feels like there are less people that are smoking just on an anecdotal basis. So we sort of feel like the tobacco industry is in decline. With that being said, there is a sort of a research study here which reads that the tobacco industry is expected to grow at a compounded annual growth rate of 1.8% from 2021 through to 2028. And it has been observed that the number of smokers has been rising at the global level. So although it can sometimes feel that, at least in my view, that less people are smoking in today, I think that's probably in the Western world. With that being said, I still feel like, generally speaking, it's a declining market. And therefore I want to include that within my discounted cash flow model. If it turns out that the market is increasing over time, fantastic, that results in more gains, and that's absolutely fine. In terms of gross margin, I've just used the average of the previous 5 years. Gross margins have actually been increasing over time, but to be prudent, I'll remain at below 80%. Operating expenses, again, I've used the average of the 5 years. They've been fairly consistent, so pretty happy with that. Now, free cash flow as a percentage of revenue, I've actually used 27%. And if we go down here, we can see that I've actually excluded one of the years, which I believe was 2018, just because there was one year where there were 38% of revenue was generated as free cash flow. And I think that that is far too high, and I don't want to include that in my forecasts going forward, as it would distort the results. So I've used 27%, which is the average of the remaining 4 years, and I think that's fair. In terms of a terminal growth rate, so we're sort of going back again to the discussion on whether the market is growing or not. Because I don't want to include any growth going forward in perpetuity, I've just put that down as 0. So I've said that the market won't decline, it won't increase, it will just stay steady after the 10th year in my forecast. I think that's fairly prudent, and I think it's probably sensible to leave it as an industry with no growth in the future. Weighted average cost of capital, again, we calculate that here. I won't run through all of the details of the calculation, but you can sort of see the overview of how that was calculated if you wish. And the current net cash or debt, so this will be included effectively as my enterprise value for the company. That is a negative $40 billion in sort of net debt. So they do have a lot of debt, which is a bit of a sticking point. I'd like to sort of find companies that have good balance sheets, but they're generating a lot of free cash flow, and they can easily service their debt. So not too concerned about that. Again, tax rate, I've used the average of the previous 5 years. So that brings us on to the 3 key metrics that I like to look at when analysing a company. So once again, revenue growth, earnings growth, free cash flow growth. So in terms of revenue growth, it doesn't look too bad. We had a significant jump in 2018. I think that's through some acquisitions. But from there onwards, it's remained fairly stable, fairly flat. Earnings growth, sort of quite choppy, but it's generally more to the upside, so it's not too bad. So free cash flow is quite choppy generally. With that being said, it's strong free cash flow in all of the years. In their worst performing years, they're still generating $4 billion in free cash flow, so that is good to see. So that brings us on to the outputs from the discounted cash flow. So I've got the current enterprise value of £101 billion, and that's taking into account the net debt that we have on the balance sheet. We've got present value of the 10-year future cash flows being £65 million, terminal value of future cash flows being £130 million, and that leads us to a total net present value after taking into account the net debt that they currently have of £155 billion, which gives us an intrinsic value of £68 per share, compared with the current share price of £26.82. So absolutely huge upside potential, which is very interesting indeed. Moving on to the earnings multiple approach, I've said that I believe the earnings in 10 years will be £7 billion per year. So for expected PE ratio in 10 years, I've gone with 8. I think it typically hovers around 10 to 12. But I think in 10 years time, again, with the increased regulation, people are more health conscious. I think that a PE ratio of 8 is probably fair. So that gives us a price per share in 10 years of just £25. And when we discount that back to today, using our weighted average cost of capital, it gives us a price per share of just £17, which is significantly lower than the current share price of £27. When we take the average of the two, we get an average estimated intrinsic value of £42 per share, which gives us a margin of safety of 58%. So with this one, you have to be quite careful. So the DCF gives us a really large intrinsic value, which would give us a significant upside, whereas the earnings multiple gives us a really low intrinsic value with a significant downside. And it's probably somewhere in the middle, which is why I like to take the average of the two, which would give us a 58% margin of safety, but you do have to be careful. So there is definitely the potential for significant upside with British American Tobacco. And at this point, it's a very slow grower. It's you sort of know what you're buying with this company. With that being said, I think there's only likely to be increased regulation on this industry, and I think that will be difficult for British American Tobacco to shake, and I think that might spook some investors. So I think it's a difficult one to decide whether this is a value play or a value trap, and I think that's something that you just have to make your own decision on after doing your own due diligence. So in terms of my opinion on whether I think that this company is a value play or a value trap, I do think that it is probably a riskier investment than it may first appear at first glance, purely down to the Biden administration with the potential for increased tax rates, increased regulatory action, and just a general increase in the health consciousness of the population and a general steer potentially away from tobacco products. So that is all for today, guys. I hope you found the video useful, and why don't you comment below as to whether you think that British American Tobacco is a value play or a value trap. And until next time, guys, thank you.